In this week's update, the pullback starts right on cue, where the global indices are headed, where there is good buying, and an update on precious metals. My name is Garry Davis, and always this is general advice only. And remember to subscribe and like the video. All right, the last couple of weeks I've been starting with what to avoid, because what we don't do and what we avoid is just as important as anything that we buy. So this is just some other thoughts on things that you should avoid doing. The first one, of course, as always, but particularly so now because the headlines are so extreme, is just to ignore them and certainly not allow them to come into your trading and investing decisions. It's just simply the worst way to go about it because markets are moving well ahead of the headlines. So it's just something you've got to avoid at all cost. The next thing is avoid sectors that are facing long-term headwinds, and it's becoming fairly obvious which of those sort of sectors that applies to. The old conventional thinking about managing risk through general diversification has had major problems for decades, in my view, but now it's even more critical because you don't want to take on board stocks that are in sectors that are really going to struggle for the next 5 years, just in the name of diversification. It's pointless. Yes, get some diversification, but only across all the sectors and stocks that are all strong, that have all got tailwinds. You know, why deliberately take on board sectors that that are going to face problems? So, just in general terms, and I cover this in a lot more detail, obviously, in the memberships, but anything that is consumer discretionary related is going to struggle. There's no telling how much damage is going to be done to the collective psyche of people. Their buying behaviour is going to change. Are they going to save more and spend less on discretionary items because of what's happened? And we have no idea how long the impact of this is going to last for. Obviously, things like travel and tourism are still highly problematic for a long time to come. And I've had a number of questions over the last few weeks from people looking to try and pick the bottoms in these sectors that are absolutely smashed. And I just don't think it's a very smart thing to do because you don't have probability on your side. Give me stocks that have remained strong and that have got an undoubted sector tailwind for the next 5 years, rather than guessing and trying to pick the bottom in something like travel or tourism or any stock that is carrying a huge amount of debt. And the final thing I want to touch on today in terms of avoidance is really expecting conventional logic to prevail, because we're seeing price actions that just completely defy logic. Because what is happening, the market is trying to price in a very uncertain future. And that future is really just made by guesstimate, by assumptions, and those things are changing almost by the week. So expecting the conventional logic to prevail is just not the way to go. The way to go is to have a very clear game plan and to apply that game plan to the technical patterns, or to look at the technical patterns and line them up against your game plan. That's the way that you deal with this sort of market. All right, American stocks on the week were strong early, and then we got reversals pretty much right on cue, as we'll see on the chart. And also on coming up to the 1st of May was a very convenient time for the market to turn down. So the S&P just dropped a couple of points, but certainly all of that was at the end, and it certainly does look like we've formed a short-term top. April saw the best gain in the US market in 30 years, and probably most other markets around the world. And then we saw a short-term top formed on Thursday night. The fear of the unknown is going to impact the economy for a very long time. 70% of the US GDP comes from the consumer, and we have no idea yet how much the consumer is going to be affected. And certainly the outlook statements from stocks like Apple and Amazon through the week during their earnings reports certainly didn't give people a lot of jubilation, I can tell you. There's a good chance that some behaviours will change for good in terms of how we work, how we shop, how we spend, and how we spend our discretionary dollars. So the business damage that's going to come from that, the damage to the outlook that a lot of people have at a personal level is going to be quite extreme, and it's going to take many years to get over. People that went through, my parents who went through the Depression, that changed their behaviours for good, now that I think back on it. And I think this will do the same. So we're going to see a series of unknowable consequences at this point in time are going to keep rolling through. And hence, it's so even more important that you're in sectors that have got enduring growth, that are not going to be impacted long term by the virus and all of the fallout from that. So an absolute must is that you need to be selective on stocks and sectors. And you need not to think about the stock market as just one entity. So the market is either going up or it's going down. That's just crazy thinking. And we just need to look at the incredible divergence over the last 6 weeks, where some stocks have set all-time highs and didn't fall at all during the crash, and the rest of the market. So that there are stocks and sectors that are outperforming by an absolute country mile. So just focus on them. The US dollar declined. It was a bit over 100 last week, came off about 1.5 cents. And you'd certainly be forgiven for thinking that the US dollar could be weakening from here, which of course is a positive for precious metals. Now the 10-year yield was steady. It's been pretty much rock solid around that 0.65% level for the last 2 or 3 weeks. Let's jump in and take a look at some of the charts. So starting with the S&P, and as I go through this, I want you to note a couple of things on all the charts I'm going to show you on America and Australia. Note the position of the index relative to this Fibonacci scale, so from the top of the crash to the bottom of the crash. And also note the position of the index relative to the red line, the 200-day moving average, and also the direction that the 200-day moving average is pointing in. So just note those things as we go through. So the S&P made it to the 61.8% level, which was, and then turned over on Thursday, spot on, both in terms of time and price. The 1st of May was always going to be a date that that people were going to be looking at for the start of some weakness, and to a degree those things become self-fulfilling because people are expecting the market to turn down from the 50% level or the 61.8% level, and because people expect the market to get weaker in May, then there will be some selling. Some computer algorithms will be queued up to start selling on those signals. And so it becomes a bit of a self-propelling situation. So you can see we were down a little bit on Thursday, and then there was a big gap down to the open on Friday and then closed right on the lows. And I'll talk about this when I get to the Australian market, but it's just amazing how often the Australian market is being used to front run the rest of the world. So when you see a major move in Australia over the last, certainly the last few months, it's been really quite extremely obvious. When you see a significant move in Australia, either up or down, it's almost 100% that the US is going to go in that direction in the following session. Okay, so we've made it to the 61.8%. That's a sign of strength. So, that's good. If it had failed at the 38.2, which is pretty much where the Australian market is, then that would have been a sign of weakness. Making it to the 50% level would have been, a neutral outcome. Making it up here is a sign of strength, and that's why I think we are going to get a higher low than what we saw in March, and probably quite considerably higher. We may not even pull back much below this green line here is the 20-day moving average. We may not come down much below this sort of area here, which is around the 2700, 2750 area. And my gut feeling, and that's all it is, but it's a bit of an experienced gut feeling, having been doing this for years and years, is that this may play out for a week or two, and then we'll get some sort of bounce and start to develop into a bit of a trading range, quite a volatile trading range, which therefore makes it very tradable. So I'm really looking forward to the next period. I know some people are a bit fearful; they don't like the volatility, but gee, when prices move as quickly as this, and there is a degree of predictability about the whole thing. The technical levels are working. The time signals are working. So there is a degree of predictability. So I'm very excited about the period ahead of us. I think there's going to be some tremendous opportunities. You've just got to be very clear in your mind about what you're doing. All right, so that's the S&P. Now, let's just look at the NASDAQ, because that obviously houses the stocks like Amazon and Facebook and all those sort of stocks. So if we take a look at the relative Fibonacci level, you can see that the NASDAQ was stronger. NASDAQ actually went well above the 61.8 before turning down on Friday night. And I think we can expect to see the NASDAQ continue to outperform. And you can see down here, this little window at the bottom shows the NASDAQ relative to the S&P. And when the line is rising, that means the NASDAQ is outperforming. And you can see that the line is clearly rising very strongly. So the NASDAQ is certainly the place to be. Technology is certainly the place to be. And that is one of the 5 enduring growth sectors that are going to do very well, I expect, in the coming years. Now, US dollar, let's just quick look at currencies. So the US dollar had a spike coming out of the crash. We've now settled down into a bit of a range with equal double tops and triple bottoms. Certainly the Fed and Donald Trump would want the US dollar weaker if they can get it. So I think we're going to see policies that try and engineer a lower US dollar. That, of course, will put some upward pressure, all other things being equal, which they're not, but that will put some upward pressure on the Australian dollar as well. But as you can see, we're still clearly in downtrend, and if there's any sort of disruption in China, then the Australian dollar is going down again very, very sharply. Okay, while I'm here, let's look at the Australian market. So again, I just want to run through the overall index and the sectors. So compared to the S&P, you can see we were only able to bounce to the 38.2% level, and a lot of that is because of the drag from the banks. There's no question that the banks and the energy stocks that make up a disproportionate percentage of our market compared to the US are having a very, very large effect, and we don't have that very strong technology sector. So if we run through, this is energy. So energy absolutely monstered, of course, as you would expect. It didn't even make it back to the 38.2. If we look at the banking sector, even worse than energy, amazingly. So the rebound has been really, really weak in the banks, and you can see we had a very strong selling day on Friday. We've got these dividend cuts and dividend deferrals. I'm not sure whether the ANZ has actually deferred their dividend or whether they've just cancelled it altogether. But certainly the dividend situation is going to have a very large impact across a lot of sectors. If we look at healthcare on the strength in CSL and Cochlear and ResMed, those sort of stocks, has done very well. And look at the 200-day moving average. It's unaffected and the price is above it. So unquestionably, healthcare has been the star in Australia. Here's materials. So materials, the strongest, or other than healthcare, the strongest part of our market, managed to make it up to the 50% levels. That's BHP and Rio and the like. But you can see a very strong down day on Friday. That looks pretty ominous. And if we look at the small caps also didn't do too badly. They certainly did better than banking and energy, that's for sure. So that's the Australian market. Just to summarise, 64.12 was where the Aussie dollar finished. We ended up 3 points on the week, but that'll disappear, I would imagine, on Monday. And there was a very, very large reversal on Friday, so I would expect to see some follow through. And as I mentioned earlier, our market is being repeatedly used by, I guess, overseas institutions to basically take a position ahead of the rest of the world. We're the first market that opens, along with New Zealand, and the intentions of those fund managers in Europe and Australia and America is being reflected in our market on the session leading into it. The other thing that's fairly obvious too is that there has been over the years quite a strong correlation between the Australian dollar and the ASX 200. So if we now expect the ASX 200 to be under pressure, which I do, because of the banks and all the other high-paying dividend stocks that have such an impact on our index, then you've really got to be bearish on the Australian dollar as well. So that creates a bit of a double-edged benefit. So if the US dollar is a bit weaker, that's good for gold. And if the Australian dollar is a bit weaker, then that's also good for gold in Australian dollar terms as well. So it's possible we may get a double benefit here. All right, turning now to precious metals. Obviously, it's a sector that's been outperforming for quite some time. Gold dropped $26, so we had another little bit of a mini panic in the last couple of days. Finished at 1702, but look, that's still a pretty buoyant level, and it's actually pretty good to see because the gold sector can tend to get a bit overheated, and so to see these pullbacks every now and again, every week or two, is actually helping the market to remain healthy. So don't be put off by this sort of volatility. Just accept that it's part of the overall uptrend, which is still very strong. The other part that I'll point out when we get to the charts too is that precious metals now seem to be consolidating at quite a high level. We're not getting deep pullbacks, as you'll see, and the pullbacks are brief. They're relatively shallow compared to where gold has come from, and it's a very positive sign. Now in America, as around the world, there's just absolutely incredible eye-watering stimulus being applied, and it's basically just to keep people and the economy from a total collapse. So the amount of stimulus that's been rolled out is certainly not the end of it. And gold is going to reflect that as more and more people start to look at their huge underweight position in gold. I'm talking major fund managers here are incredibly underweight gold. Most of them have well under 1%, and a lot of them are not far off zero. So that increasingly people are going to be looking at that and just thinking, I really do need to get my exposure to gold higher. And I think that thought process will progressively roll through the community and through the institutions. It's not all going to happen overnight, and I hope it doesn't happen overnight, because if prices move too quickly, then it just creates unstable markets. So it's going to be a progressive thing, and it's going to build up over years to come. But the point is that the stimulus rolled out so far, as incredible as it is not even close to being enough. We're going to see that continue, and you can bet your life that Trump is going to be pushing for as much stimulus as he can get before the election. Now, if we look at precious metal stocks, GDX was down slightly as it consolidated the breakout. And a couple of things are certainly in favour for the precious metal stocks. The GDX to GLD ratio, so GLD is basically the gold price. So that ratio is roughly half its long-term average. So there needs to be some catch-up by gold miners on a long-term basis to the price of gold. Gold miners have never been cheaper relative to the gold price. And the other ratio, and I pointed this out last week, is the gold to silver ratio is worse than half. In other words, it's gone the other side of halfway on the long-term average. So there needs to be a massive reversion to the mean by silver to catch up to gold. So if gold keeps advancing, then, which I think it will, then GDX has got to catch up, and silver has got to catch up even more. So I think there's a lot of good things in the pipeline for precious metals. So let's just look at gold first of all. This is gold on a weekly basis. You can see the uptrending channel that started at the end of 2018, down around $1,240, $1,250. We're now at $1,700. We had a brief drop out of the channel during the crash when it was just really a liquidity event for a week or so, but very, very quickly returned to the channel, and now we're trading right up the top. So, and we're consolidating at this sort of high level. So it's a very, very positive chart, that one. Look at it on a daily. You can see we're getting this consolidation here since the middle of April, where you can see the 200, the 50, and the 20-day moving average, and we're holding above the 20-day moving average, which is really a sign of strength. When you see price holding above the 20-day moving average for anything, you know that that the trend is very, very strong. Silver not really moving yet, and I guess part of that is because silver also has industrial demand as well, which is probably on the weak side at the moment. But silver will come into vogue, and we're seeing it already. There is money flowing into the silver ETF, a much higher level of money flowing in there than is normal. And so we will see a response, I'm sure, in the silver market. Now, this is the spread that I showed last week. Normally, the ratio between silver and gold, normally it takes about 50 ounces of silver to buy 1 ounce of gold. That ratio now is up at 113. We saw a spike when all the prices collapsed in the middle of the panic, and it's pulled back a little bit, but there's still a lot of mean reversion yet to bring this all the way back down to the bottom of the chart here. So I think potentially we've got a very good period ahead for silver. And just to check in on GDX before I leave precious metals. So GDX finally managed a breakout, which occurred last week. So you can see this is a big base that started forming back in 2013. So this is a 7-year base. And you can see we broke out last week, and then a little consolidation, which is pretty normal. And I actually do like to see that rather than the price just absolutely rocket away. But you can see of late, certainly the GDX has been outperforming the S&P, and that will also bring more money into GDX as well, into the gold miners, because the one thing that fund managers can't do is to not be on board sectors that are outperforming the S&P. They just have to. So this also becomes a self-propelling mechanism as well. All right, other commodities, copper, steady at $2.31. The long-term outlook, I'm talking 2 years and beyond, is really quite positive, driven, I think, by the commodity cycle that hasn't really got going yet, and also by the demands from electric vehicles. But look, the short term is really just a guess. No idea what copper's likely to do in the short term. Crude oil has been obviously well documented, the way that that market has been belted around, firmed a little bit, up about $1. But it's still extremely volatile. We've got a lot of things happening in the futures market that have never happened before. We have negative oil price in the futures market for a day or so in the last month. Could even see that again this month. Who knows? So extreme volatility there. But as I said last week, I really think there's a trading opportunity for the world's biggest energy stocks. I think they've just been drastically oversold. This is not an investment, as I would see it. It's not something that I'd be interested in holding, but it's certainly a trading opportunity from just a crazy level of oversold. There's the spot copper chart. Not a lot of change there in the last week or two. So just wrapping it up, what to buy? I just keep harping on this all the time, and it amazes me that I still get questions from people that are really coming from a point of, diversification or trying to buy turnaround stocks in sectors that have been smashed. I really would encourage you to stop doing that, because it is not a high probability approach to the market. And that's what you need on your side in this kind of market. You need the odds stacked in your favour. You don't want to go trying to pick the bottoms in turnaround stocks, because that's a really low probability exercise. Just focus on the best stocks in the sectors that have got the long-term tailwinds, and I talk about that all the time in the memberships. The other area is also where there's current outperformance. So in other words, the price action. The strongest stocks in the market are there for a reason. And that strength is likely to lead to further strength. And that's one of the things about the market. Don't ever be afraid to buy high, to buy strength. Now, I don't mean by that you should chase prices, but don't be afraid to buy the strongest stocks in the market, because they're there for a reason. How should we think about the market? Well, look, if you're not bullish longer term, and I'm talking 6 to 12 months and beyond, then you should be, because there's absolutely every reason for that. Almost every major economic cycle ends with a real commodity cycle, or a super strong commodity cycle to end the business cycle. And that hasn't happened. We haven't seen that this time round. I think that's yet to come. And all of this incredible stimulus, I think this time may well lead to an inflationary period. The next point I want to make is that technology advances, be it in the digital world, be it in the healthcare area, wherever it may be, technological advances are not going to stop. In fact, one could argue there's even a greater need now for technology to provide solutions. So they're the sectors of the market that are going to do extremely well. I don't know what the index is going to do, to be honest, and I don't really care, because I'm not trading or buying the index. I'm just trading the strongest stocks in the strongest sectors. Now, creating a wealth effect has been the Fed playbook since the early 2000s. Bernanke did this to a T, and the phrase was coined the Bernanke put, which is basically the Fed was always going to be there to backstop the market. The Fed knows this, and they know that there's been incredible damage done to the consumer, and one way to fix that is to have a very buoyant stock market, because that makes people feel wealthier. So, don't be surprised to see the Fed doing things that they've never done before. Otherwise, how else are they going to get the consumer to spend unless they make them feel like they're wealthy again? So therefore, to me, this all adds up to, and I know things look a bit grim at the moment, and the news is going to be bad. It's going to be bad for 6 months. Corporate profit results are going to be ugly. Economic data is going to be ugly. But Wall Street looks ahead. And Wall Street knows that buying the dips is still going to work, because the Fed is going to be there. You've just got to look at what the Fed said. They've said repeatedly over the last 3 or 4 weeks, we'll do whatever it takes to prevent the economy falling apart. And so I think buying stocks just has to be part of the process. Japan has done it for decades. The Bank of Japan is I believe, one of the largest owners of the Japanese stock market. Certainly it has a very strong position in all of the major Japanese ETFs. Now, circumstances around the world are now far worse than what Japan has faced for the last 2 decades. So why wouldn't the Fed do it? I think it's almost a given that the Fed's going to be buying into the stock market. And finally, self-interest always prevails. Trump can't win the election without a buoyant stock market. He may not win the election even with one now because he's handled this whole corona thing absolutely disastrously. But he cannot win without a buoyant stock market, and he knows it, and he's going to do everything in his power and put pressure on the Fed to keep the market buoyant. So that's how I see things at the moment. Portfolio analyst, I'm having a week off this week, and I'll be still keenly watching the market, and I'll be back with you next weekend. For anyone that wishes to communicate with me, there is my email address, and also for further information, you can find that on our website. I'll be back with you next Sunday. Cheers.